bring to the show my first guest this morning, Marc Ostwald, Global Strategist, ADM Investor Services. Good morning, Marc, and thank you so much for joining us.
Good morning.
So we've heard earlier this week from the ECB, we've heard from Jay Powell, but mostly from ECB and the Australian Central Bank. The ECB and the Australian Central Bank, they just said it very openly. We don't like what we see. On the other hand, just a few minutes ago, probably 1 hour ago, we've heard from Bank of England Chief Economist Andy Haldane warned that inflation may become difficult to tame, prompting more assertive policy actions. And not only Bank of England official warns inflationary target has awoken, sending bond yields higher. I was wondering, Marc, what's your take on inflation, and do you think that Powell could have communicated better to markets?
Well, yeah, I think the problematic here is the Fed and to a certain extent the ECB want to have their cake and eat it, and the Bank of Japan indeed. They want to talk up how the economies are going to recover, how they've helped enormously. On the other hand, they want to keep financing conditions, as the ECB is keen to stress, not financial conditions, ultra accommodative. The problem is when you've got, you're supplying as much liquidity as they are and swamping markets, and you're suppressing interest rates, particularly short-term ones, that liquidity needs to go somewhere. And so you're basically almost talking to the deaf, because a lot of the things, particularly say in commodities, a lot of the money is speculative now. We've got one of the biggest speculative we do actually have the biggest speculative position in commodities as a whole ever. So, I think the ECB is also in a difficult position, because it's had this narrative since the last meeting of, oh, well, we won't necessarily have to use all of the PEP because there is this internal struggle there. And then suddenly it's like, oh, no, we don't want to actually see bond yield rise. Well, make up your minds up, guys. You're going to have to talk it one way or the other. And at the moment, I think markets have got a case of, well, they're probably being too negative and too accommodative, and the twain shan't meet. I have to stress, though, with all these moves that we've seen in the last couple of days, that particularly the last 2 days, a lot of it probably is to do with month end. We had a great performance from stock markets. We backed up interest rates, long-term yields up a very long way. There was always going to be a natural rebalancing going on away from equities into bonds. And as we know, basically, as much as there is a lot of central bank liquidity in markets, there isn't a lot of depth. There isn't a lot of market liquidity. And so we get these ever sharper movements. And the most significant one of all yesterday being, above all, the fact that the S&P 500 dividend yield was breached by the 10-year yield, and that's time and time again always a trigger for something of a stock rout, and for people to go, right, actually that means that equities aren't so cheap relative to bonds, so basically we may need to rebalance. And so it proved. The volatility, I would say a lot of it is actually being, yes, there is a lot of speculative money, but the speculative money is mostly as a result of central banks.
I think what you've highlighted is really important. On the other hand, I was wondering, do we have to necessarily think about higher inflation when we see higher yields?
Not necessarily. I think in these markets these days, you always have to try and distinguish between what is short-term momentum trading, of which there is a lot, i.e. people trend chasing, not necessarily with any view which has conviction behind it that this is the right thing to do, but merely because there is momentum behind it. That's also to do with excess liquidity. Do we need to really worry about inflation? Well, I think that as we saw with the French and Spanish inflation data in the Eurozone this morning, we're going to have a very unclear picture. Some of it's due to do with compositional effects. Some of it is to do with what are likely to be temporary supply chain disruptions. But those supply chain disruptions could be a lot more permanent than people think. But we don't really know how permanent or how transient they're going to be until we get into a situation where, thanks to the vaccine rollout, we are confident enough to start opening up most economies. And then we'll get back to some form of equilibrium demand. I prefer to call it an equilibrium demand than normal, because I don't think we know what the new normal is going to be. And then we'll find out how badly our supply chains have been damaged and what precisely that will mean in terms of inflation. Because if the supply chains have been damaged more permanently, we've lost production capacity, then that will certainly have an impact on prices upward.
Let me ask you another question in regards to the Fed. Can we expect any technical move coming from the Fed just to calm down markets and specifically to hold treasury yields increase?
I think at some point they need to actually think about what, how they're going to, they need to think about whether they need to take action rather than just talk. Because at the moment they're very, very reliant on talking the talk but not walking the walk. And I think with all this excess liquidity around, I think their biggest problem is that markets will test them. Once we've got through this end of month period, so we're back in a new month next week, markets will be looking at it and saying, well, the Fed's basically saying they're going to be conducting ultra loose monetary policy. Let's see how much they want to actually keep things down, and they'll test the Fed's resolve. And I think the most significant thing that we need to keep an eye out on is just how much we're seeing that impact on US tips yields, because one of the biggest moves that we've seen over the month is that 25 basis point rise in real long-term interest rates, which is something the Fed will be much more uncomfortable with than the rise in nominal yields. Nominal yields fine, as long as it's actually basically just reflecting we're getting back to more normal inflation levels. But if you're actually going to start raising real interest rates, even though they're spectacularly low, one has to say, what we're talking about is we've gone from minus 1.05 to minus 0.8. Minus 0.8 is still super, super low. But the more it pushes up, say it gets to minus a half, the more people are going to be saying, so where's this yield curve control?
In fact, I just want to hear your take on, the Bank of England chief economist Andy Haldane remarks in a recorded lecture. Haldane noted that there were both upside and downside risks to the inflation outlook, but cautioned that an inflationary tiger had awoken. So I was wondering, what's your take? And certainly this is not a good news for Andrew Bailey.
I don't think Mr. Haldane's he's been on the hawkish side for quite some time now, for about 9 months. He does tend to blow in the wind, but at the moment he's definitely erring on the hawkish side. So I'm not really surprised by his comments. He's been very upbeat on the economic outlook. A couple of times that's been a little bit premature, as we saw from last summer. He is very much someone who believes in the pent-up demand. So we're talking about someone who believes that the pent-up demand is going to really give a lot of problems due to the supply chain disruption and create a lot more inflation. I'm not really sure that is the consensus view on the MPC. I think he's a little bit out on his own on that one. I have some sympathy, but I think actually the jury's out. We've still got a lot of disruption, and in the UK there are additional disruptions due to Brexit, which are still working their way through the system. Whether we get more enduring inflation is going to be the key issue. I don't think the Bank of England, above all, is necessarily keen on doing a lot more in terms of keeping policy easy. In fact, they've already hinted that they might actually start to taper their own QE measures if they feel that the economy is picking up. So the Bank of England are probably slightly, I think probably it's not more hawkish, it's less dovish than some of the other central banks.
All right, thank you very much. Marc, also Chief Economist and Global Strategist, ADM Investor Services. Thank you for joining us and have a great weekend.
And you.